first of all, let's be very clear. Everything is manipulated. What are we talking about here? Everything is manipulated. And no, everything's, of course it's manipulated. The Treasury is manipulating liquidity. The Fed is manipulating liquidity. They're manipulating algorithms by what they put in a statement that they're probably going through AI to filter as far as to see what the reaction by the other algorithms are. Everything's being manipulated. There's a hell of a lot of recency bias that's going on now. Like a shocking amount of recency bias. And when everybody thinks the same way, it's probably time to think differently. When I say there's not enough leverage or it's not no real leverage in gold, what I'm talking about is that there's no over-optimism, there's no overconfidence in gold. I don't see people excited about gold. Bitcoin reclaims 100K. And it's like, oh my God, what is going on? That people are like, this is like a casino. That we're just creating content around. Like, nobody's talking like that for gold.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to help us understand the micro. My name is Kai Hoffman, I'm the Edge AI mining guy over on X, and of course your host of this channel, and I'm tremendously looking forward to welcoming back Michael Guyot. He's the publisher over at the Leadleg Report, somebody I'm following on Twitter quite a bit, and somebody who's quite loud on Twitter, but he's quite tame when you get him in person, and really looking forward to chatting with him here to prepare a bit of an outlook or discuss the outlook for 2025. It feels like, to me at least, that we're in a bit of a weird time in the markets right now, bit of a limbo mode. It almost feels like market is missing direction, in my opinion. I think we're all waiting for the inauguration January 20th, but I'm really curious what my guest has to say about that, where we're headed, and what things look like in the markets right now. Before I switch over to Michael, please hit that like and subscribe button. Helps us out tremendously, and it's a free way to support us. Really easy to do. It's a little button down there as well. So thank you so much for that. Michael, Happy New Year. It's great to see you again. Thanks so much for joining us.
Yeah, am I loud on Twitter? Is that really how people perceive me? I don't know. That's news to me.
Is it? I don't think so. You know your personality on there. We've chatted about that before, and I enjoy it. It's a bit different. Sometimes you have to be loud to make noise and be heard. So I don't mind it. Michael, lots to talk about. We haven't talked in 12 months, so really curious where your head is at these days. But maybe we'll start off with a bit of an opening question and risk on, risk off. Where are we at in the markets right now?
Can I say yes to both? Because it's like I get people are like, oh, you've been risk off the whole time. It's like, no, that's not true. It's like you can be both offensive and defensive. You can be both bullish and bearish. It just depends on your time frame as far as whether you're bullish or bearish. I mean, Leadleg Report signals I just put out this morning, all risk on. Okay, I mean, based on the rolling look back period of the respective signals, that could change by end of week or the week after or the week after that. I have no idea. So yes, I'm not some perma bear that's always risk off by any means. I mean, that's kind of comical. Anybody that looks into the research can see that. Okay, but let's talk about kind of where we are here. I do think that this is going to be an interesting year from a lot of perspectives. I think it's true that everyone's waiting on the inauguration, to your point. I think it's more true that people are waiting to see what happens as far as deregulation. Under a Trump presidency, that seems to be one of the major themes that we're going to see out there. Everyone's talking about tariffs, but the deregulation push looks to be a pretty big one. I saw Trump was basically making the argument that for every new regulation that gets proposed, there needs to be 10 other regulations removed. So this seems to be sort of the next major theme to pay attention to. Now, that could be quite bullish, conceivably. And really bullish for small caps in particular, because typically deregulation benefits smaller, mid-sized companies. But aside from that, I still think that there's going to be more volatility. I know I was wrong on that. Last year, with the exception of that reverse carry trade momentarily in early August, I think that we're just probably due for more gyrations. Doesn't necessarily mean you have to have a collapse. But there are real risks still out there. And I keep saying gold descending warning. I still maintain that gold descending warning. I still think that there's a lot of complacency that can shock people the other way around, but when is anybody's guess?
Yeah, no, it's like interesting points there. Maybe like we'll go through it. What you just mentioned, topic by topic, but deregulation is an interesting one. Like, A, how will it affect markets? B, where do you see the biggest impact? You said small business. Can you elaborate on that?
Yeah, I mean, theoretically it should, right? Because regulatory burden is an expense that crushes margins, and your margins are going to be tighter, obviously, if you're a smaller or mid-sized cap company. And we've seen obviously the market react to a lot of deregulation hope around the crypto space in particular. Some of the regional banks have gotten some big movement as well. So I do think in general there's going to be a lot of interesting investment opportunities when it comes to deregulation. Now, having said that, personally, I think the most interesting aspect of deregulation could very well be what happens to cannabis, which has been a horrible place to invest in for the last several years. But if somehow in the next 4 years, cannabis ends up becoming a bit of a priority for the administration and we see some real change there, yeah, you know what? Some of these cannabis companies could really, really soar from very beaten down valuations and pricing and prices. So I think, yes, it's a lot of interesting opportunities. More volatility should bring with it more opportunities. I am of the mindset and opinion that the most mispriced asset in the world by far is long duration treasuries. I am, of course, biased in saying that because that's the risk off option in my own tactical strategies. But I think it's only a matter of time until we see that flight to safety trade finally come back, because credit spreads can only stay so tight for so long. And yes, I've been wrong on the timing of that, but you can't really just ignore the complacency that's gone on in the bond market outside of the duration bear market we've seen.
No, it's that's I think the crux of the matter is really timing, right? That's what it really comes down to. And we've all been calling for a recession for the last 2.5 years, still waiting for it. Really, numbers tell us a different story. Maybe we'll start there, Michael. Like 2025, do you see the chance of a recession even happening?
It's an interesting question because it seems like the uninversion of the yield curve would suggest it's possible. Yeah. Right. I mean, just based on the lagged effect of that uninversion, typically when a recession on average tends to occur, being this year, which is not a very sort of, it seems like an odd thing to think through, right? Because markets are new highs. What do you mean the market would anticipate a recession? Yeah, that's largely true. But just because it hasn't anticipated it today doesn't mean it can't anticipate it tomorrow, starting tomorrow. All right. Possible. I do think that a lot of the hype around Trump outside of deregulation could end up being misplaced. And what I mean by that is, yes, we're probably going to see tax cuts, but it's probably not going to be as significant as he's making out to be. Yes, we're going to see tariffs, but that may not be as significant as it's being made out to be. So it's going to create just an injection of uncertainty. And when you have so much leverage and speculative fervor going on, as I mentioned in some of these leverage types of products out there, you don't need to have a recession to have a big decline in stocks. You just need to have a big decline in stocks to happen all by itself, which has happened many, many times in the context of a bull market.
Yeah, it's like you touched on it. We've seen that decline back in August. Like the market was where the market seems extremely nervous, and everybody tries to run through the door at the same time when the moment is right. And we maybe might have seen a hint of that. The unwinding of the yen carry trade here. How nervous is that market right now? It's like you just hinted at. It's like everybody wants to sell at the same time. Everybody's sort of in the same stocks right now. It's still the max 7 for everybody here. Is the market like, I don't know, how nervous is the market is maybe the main question here.
It doesn't seem like there's any nervousness. I mean, you can see it in the sentiment on social media, right? It's like, and we are now at the stage of the cycle where the bulls who have, in quotes, been right, and really they've only been right based on the indexes, not based on small caps and most things, which again are still, after inflation, doing terrible relative to 2021 respective highs. We're getting to the point where there's a hell of a lot of, I would argue, beating of the chest, arrogance, look how great we've done type of sentiment out there. And I would remind people that hubris, and I've been through this in my own career, occurs before you start to fall. Right? It's when you feel like you're walking on water that you start to sink. And for whatever it's worth, I just think anecdotally we're seeing a lot of that. Now, again, that's not a timing, argument. It's just saying that we're clearly at a level where people are all on the same side of the boat. And, look, the crowd is right on average, just not at the extreme. So the only question that matters is, are we at an extreme? Markets being at new highs is not a definition of an extreme. People being all in on markets is by definition an extreme. And there's all kinds of interesting stats that do suggest that when you look at household asset exposure to equities, you look at optimism, sentiment, we're kind of at that point where mean reversion might kick in.
It's an interesting topic. Like, the market makes me really nervous. The S&P 500 the last 2 years up 24, 25% each. 2022 was a bit of a different year. A lot of different impulses there. Minus 20% for the S&P, but the years before, again, plus 20%, almost 25% each year. Like, can we expect the same now in 2025? It's like we get used to it, right? Like, we're being treated like it seems too easy to make money in this market,
Yeah,
right?
you know what's interesting about this is that it's no different than the arguments around how whatever generation it is the most entitled generation out there. Whatever what I don't know what their generation is, like the younger traders, right? It's like everyone thinks they're owed 20% annualized returns, that they're owed the market keeps going higher, that they are so intelligent based on some squigglies they put on a chart, which are really just being driven by 7 stocks largely. That they think they're owed those types of returns. It's like you're not owed anything, right? It's just these moves happened in 98, 99. Remind me what happened in 2000. Doesn't mean you have to collapse like what happened in 2000, but there's a hell of a lot of recency bias that's going on now. Like a shocking amount of recency bias. And when everybody thinks the same way, it's probably time to think differently. Again, I don't know when I've been wrong on a credit event. I've made that very clear. I'd argue have been right and wrong in the reverse carry trade. It worked for 2 days. I then said Monday, August 5th, that they're going to rally the hell out of the market. I still think the reverse carry trade risk is out there. Can happen overnight, like it already did, right? But outside of that, it's like I was on another podcast, and the podcaster said, because that's like the impression out there, you've been bearish on stocks for a long time. No, I haven't been bearish on stocks for a long time. I said at the end of 2023, I expected a credit event, which never happened. Then I argued for gold and utilities, and those crushed it since October of 2023. But I said it's not that I'm bearish on stocks. It's that I'm bullish on a tail event. I think we are way overdue for an extreme decline. Okay? And that doesn't mean it has to stay down. I don't know why people get so offended by the idea that stocks can have a big decline out of nowhere. Shouldn't you want that if you're an investor? Shouldn't you want to be able to buy low? I mean, I fail to understand how people think if they're truly trying to generate wealth, if they think stocks go up forever, meanwhile they will average up when they should really be averaging down.
Yeah, dollar cost averaging, I think, is the word here. It's an interesting perspective. Like, just sort of maybe summarizing what you just said, Michael. Here, last 10 minutes we discussed Russell 2000 over S&P 500 in 2025.
I would love to see it, and again, I go back to maybe deregulation ends up being the catalyst for that. Look, the only thing that differentiates largely large caps versus small caps, as far as the drivers of momentum, is tech. Right? I mean, large caps are being driven entirely by the tech play. Small caps, as a part of the marketplace, tend to not have that much tech. So, to the extent that small caps rally, you need to have tech leadership stop, which is not stopping, clearly, at least to start 2025. I would love to see small caps run. I keep saying small caps hold the key. If small caps run, it means credit spreads were right all along by being as tight as they are. That there's no default risk, whereas small caps have been saying there's default risk by the very nature of the fact that zombie companies are holding back the Russell 2000. Yes, there is a possibility that small caps rip this year. Absolutely have massive, massive outperformance. The only caveat to that is typically small caps outperform in bear markets. Or outperform meaning up more or down less. They'd be down less because they've already discounted a lot of relative weakness. But, if you're going to say, what would you rather allocate to? I'd rather allocate to anything outside of the S&P if you're going to be long only equities. Go into international, go into small caps. I mean, typically the old leaders get old and then something else emerges. The leaders become laggards, the laggards become leaders, hence the lead lag report.
Yeah, talk about lead lag report. I was going to ask you about inflation, and maybe we should attack it from the angle of the Trump tariffs or proposed tariffs here as well. Like, what do you expect the impact to be in 2025? I know it's a lot of speculation. We're recording exactly 2 weeks before the inauguration, of course, so kind of tough to make a really 100% clear prediction here. But given your expertise and what the charts maybe are telling you here, Michael, what do you expect is going to be the impact?
I know everyone assumes the tariffs are going to be inflationary. They likely would be, but again, I go back to magnitude, how pervasive, and then what other countering factors are there. I mean, if the market were to have a hissy fit over tariffs, then I can almost guarantee you that Trump would walk it back because He loves the S&P. He loves stocks. He rang the bell pretty much at what looked like a top for a moment in time at the New York Stock Exchange. So I don't know. I mean, the inflation argument, I think it's very clear that the inflationary pressure is still very much remains, and it remains because the Fed stupidly lowered rates with credit spreads near all-time lows. That never made sense to me. Why would you start a cutting cycle when credit spreads are telling you there's no stress? Right? So small caps have been saying there's stress, but the bond market has not. Right? And candidly, that's been sort of the major error that I made the last year and a half, 2 years of my macro framework, which is that I assumed or thought logically, at least I thought logically, that the fastest rate hike cycle in history would have a lagged effect that caused some kind of massive disruption. It did momentarily with the regional banks, and then the Fed, again kept on draining liquidity as Yellen and the Treasury kept on putting it back to the system. So the net effect was what? Easy financial conditions. I never thought that you'd be in a situation where the government is countering the Fed, but that's exactly what's happened.
No, interesting times we'll live in, especially now with the new government coming in. We'll see what Scott Bessent is going to do here. Yellen, appalling job apparently. A lot of short-term treasuries and T-bills that were issued here that could come home to roost actually this year, which will be interesting. But bond market, maybe we stay on that because I just mentioned treasuries and bonds as well. Like, what's your what do your indicators tell you about the bond market? I'm looking at a 10-year treasury yield of 4.64% right now. They're not at 10 yet, but their bonds are selling off right now, especially a 10-year. Like, what are your thoughts on the bond market right now? What is it telling you? What is it trying to predict?
Well, I mean, I think it's interesting because I mean, one of my friends has got some great research. Andreas Stena Larsen put up posts out saying it's odd that the 10-year yield keeps rising when all the inflationary and macro data is either sideways or down. Is it just a supply issue? Yeah, maybe it is. I think there's an element of the market is expecting more inflation, right? Maybe it's just a rejection of U.S. Treasuries because there's disgust around how much debt there is. But even that argument doesn't make sense to me because, sure, U.S. debt keeps on skyrocketing, but so is equity market capitalization. So, it's like which is more extreme, the U.S. equity side or the government spending side, in terms of the actual dollars that are being a liability or not. I said at the start, I think long duration is probably the most mispriced asset out there. And I say that because if everything is valid around AI, that's going to be disinflationary. I mean, tech is disinflationary, historically at least. Yeah, you can argue that all the data centers will need a lot of electricity, but all right, well, Trump's coming in and is going to probably jam energy prices even lower. All that sounds disinflationary, not inflationary, which should mean yield should on average be lower.
He wants to have a say in the Fed and the Fed policy, and I think there's a lot of wishful thinking because I don't think there is a chance through Congress that will happen. But of course, he can try to influence it, at least publicly and through social media. And apparently, he's got a strong ally there in Elon Musk, trying to push the Fed maybe towards lower rates and support it. But does that even make a difference? Like, the U.S. has to issue at least $3 trillion next year just to reissue bonds that were issued on a short-term basis, plus the deficit that needs to be financed. Credit event, I think, is the buzzword I'm going after here, Michael. Is like, when we talk about that, I'm asking for your definition just to clarify it for our audience because you haven't been on in 12 months, Michael. And B is like, are we running into a credit event / liquidity crisis this year?
I don't know. I've been wrong on that. I thought the reverse carry trade was going to be the catalyst. Again, it was for 2 days. The VIX hit 65 very suddenly, right? I mean, and I got I got 20,000 followers on a single day because everyone knew I was the guy that was adamant about the reverse carry trade, and I still think it's out there. But I don't know. I mean, this whole environment has been very frustrating because a lot of the historical stuff is not, in quotes, working the way it was prior. There's not as much co-movement. If you have small caps really start to run, which again I would love to see, then yeah, a lot of that gets postponed, I think. I mean, look, a credit event by definition is just a VIX spike because credit spreads correlate to volatility in equities. That's all it is. It's not some scary thing. It's what I'm saying. It's the tail event, which is the way markets behave. Obviously, my timing has been very wrong on that, and I go back to the reason I think is because of Yellen. Okay, but could it still happen? Sure. And candidly, it probably happens when I give up on the idea. That's always how it works.
That's always like once you change your mind, you say, let's
Yeah,
it's
that
going to look
starts to
something
happen.
different, and then it just happens, right?
Selling the low. I mean, that's what it is.
Absolutely. No, it's like we haven't talked in a while, Michael, but the disconnect between the economy and the markets. Like the markets, of course, running at an all-time high. Economic data, like if we take it at face value, looks all right. Like, does the market and the economy make sense to you at this point, or is there still a massive disconnect?
Well, you said it correctly, at face value. Right? It's like, how many revisions are there out there? Does anybody really have a clue what the real state of the economy is? Because I would tell you what, small caps, if that's a clearer sense of the real state of the economy, have been saying, yeah, it's okay. It's not phenomenal. Right? I mean, small caps are much more tied to the domestic U.S. consumer than large caps, which are multinational. So if you want to make a play on the U.S., you're making a play on small caps. It hasn't really worked that well. I'd rather use market prices than economic data from policymakers that are trying to stay in power.
Like talking about those indicators, like have they changed over the last 12 months for you? Like, have you weighted them differently? Like, are you giving more weight maybe to inflation data, unemployment data? I'm just, I'm not trying to put words in your mouth here, Michael, but
Yeah,
curious, like if that's changed at all.
I use a lot of intermarket signals, right? And the way I tend to kind of form a thesis. People will say, oh, your lumber to gold signal has been wrong. There's no predictive power. It's like, that's stupid because you can look at the white paper, which is pure fact on that. And actually, as a matter of fact, lumber to gold has actually worked out very well. What has not worked is the expression of treasuries against that signal. That's a whole different discussion. So no, I mean, to me, I still believe that there's cause and effect. I still believe that when utilities outperform the market, that tends to be a defensive signal. I still believe when gold is outperforming lumber, that tends to be a defensive signal because that belief is proven in history outside of the small sample of the last year and a half where treasuries have failed independent of whatever signal you followed as a risk-off option because you've had no real risk-off because credit spreads have stayed tight. I mean, that's just the reality. As far as economic data goes, I don't know. I don't think any of it matters. I think this is a pure liquidity-driven type of environment. I think it's a pure leverage-driven, which is part of liquidity-driven environment. I've used that line many times before on X, and I maintain this, even though it hasn't happened, obviously, yet. The precursor to every crash is leverage. The precursor to leverage is overconfidence that the current trend persists ad infinitum. And I go back to, we have never been in such a bull market for recency bias in history. And I think that's at some point going to kick everybody in the pants. I don't know when. But I'll probably be loud on X whenever it happens. That's the one thing I do know.
We'll probably see it and hear it to 2 degrees, like even just capital letters. I'm sure there'll be a lot of use of capital letters here.
I don't know, man, because now apparently that algorithm change is coming, meaning I have to be positive. So I'm going to say it's exquisite as opposed to the other F word. That's not
hashtag sarcasm, right? Just preface everything with that, and you should be fine. I haven't looked into the algorithm changes yet and that are planned here, but it'd be interesting. Risk off wise, like you mentioned 4 categories last time. Treasuries, gold were 2 of them. What are your favorite risk off trades right now? Like, how are you hedging?
Well, again, so in terms of the strategies I run, which are rules based, those are not based on what I'm thinking, right? It's using long duration treasuries. I do think gold probably still has a lot more room to go. I mean, I still maintain that gold is the ultimate diversifier because historically it doesn't correlate to very much, kind of marches to its own beat. Not a lot of leverage in the gold market because people are leveraging crypto and Bitcoin instead. So I think gold still has that counterparty attractive aspect to it. I do worry about the dollar continuing the way it's been continuing. Now, maybe it's a top or close to a top. But if the dollar were to keep on rising, that is going to be a self-fulfilling risk-off play because it creates this almost short squeeze dynamic where it creates some funding stress in international borrowers. That financial stress then results in the dollar even going up further. And, and then it's like, a blow off in the dollar, which would make it a risk-off play, but would probably be very painful for everything else around it. And I still think utilities look interesting alongside healthcare. Healthcare is going to be unique in the deregulation trend, I think. See what happens as far as deregulation and FDA approvals. But But yeah, I think there's a lot of interesting dynamics that are coming. Either way, look, the last 2 years have been shockingly good for U.S. large caps. We know a large part of that's the AI, NVIDIA, Meta type of plays. We're probably due for some broadening out, but broadening out can simply mean that the things which have not participated go down less, while the things which have driven the rally go down.
You mixed a lot of topics, so it's difficult to ask for like follow-up questions because you brought up healthcare. Now I want to ask you about the mining sector because you talked about deregulation. So it's like, maybe we'll throw in the mining question here now because I want to come back to gold because you said something interesting as well. But maybe just because you mentioned healthcare, like what do you make of the mining sector? Joe Biden just gave a permit to the Stibnite project in Idaho, just EPA approval there. Like, do you see any changes there? We can expand that to oil and gas potentially as well. Like when you talk deregulation, is this something you look at all?
It's an interesting space. I defer to my friend Axel Merck on that, from Merck Investments, because he knows that gold mining space very well, and is also quite familiar with some of the potential deregulatory aspects of that. You should have him on the show.
I speak with him actually on Thursday, so it's an interesting coincidence.
yeah, exactly. I think anything that has to do with the environment is going to ultimately be deregulated. So anything that benefits from deregulation around environmental standards will benefit. So to the extent that that impacts the miners, yeah, that should be a positive tailwind.
Okay. Let's talk gold. You mentioned something that I think we need to dissect a little bit. You said gold is not leveraged enough, or there's not enough leverage in gold. Can you explain what you mean by that? Because everybody, like, I'm sure we'll get some comments below this video. It's like, oh, but the gold market is manipulated. So I'm curious, like, what do you mean by that? And the one way you manipulate the gold market is through leverage and, paper gold. So I'm curious what you mean by that.
First of all, let's be very clear. Everything is manipulated. what are we talking about here? Everything is manipulated.
There's my YouTube title, by the way.
I know, everything's, of course it's manipulated. The Treasury is manipulating liquidity. The Fed is manipulating liquidity. They're manipulating algorithms by what they put in a statement that they're probably going through AI to filter as far to see what the reaction by the other algorithms are going. Everything's being manipulated. Like, what, you think fair value for the S&P 500 is where it is now? That's not manipulation. So when I say there's not enough leverage or it's not no real leverage in gold, what I'm talking about is there's no over optimism, there's no overconfidence in gold. I don't see people excited about gold. I see a lot of people talk about Bitcoin 100K. I see random posts about live streams. Bitcoin reclaims 100K. And it's like, oh my God, what is going on? That people are like, this is like a casino that we're just creating content around. Like, nobody's talking like that for gold. When you start seeing, that type of stuff on X, and silliness around gold like you're seeing in the crypto space, then that means there's leverage. And that's when it's going to turn negatively.
No, I appreciate you clarifying that. No, we don't have our own fart coin in the gold space yet, so I'm not seeing that type of excitement.
I put out that post. I said, fart coin. The Fed will raise rates because of fart coin, and it's like I'm actually serious about that because it shows you there's too much liquidity. There's too much stupid shit that's going out there. Pardon my language. It's ironic to say with Fartcoin. Just too much stupid stuff out there that people are just throwing money at. I'm not against gambling, but it's like when you have speculative fervor like this, it only happens when there's liquidity and too much of it.
Yeah, we've seen it with the NFTs. We've seen it with the bored monkey. And like, what did Justin Bieber pay for a sticker of a monkey or whatever it was? So, yeah, too much liquidity in the markets. One last topic I want to tackle with you here, Michael, is geopolitics and how you sort of factor that into your analysis and into your rules as well. You touched on the carry trade, so that's a bit of geopolicy or geopolitics in there. But I'm thinking also like what's happening in the Middle East. How is that sort of weighing on your rules-based system, and how do you factor that in?
I mean, first of all, it's a rules-based. You can't really factor in any of that stuff, and it's always an unknown. I don't know. It's not clear. I mean, yeah, maybe Trump is able to kind of figure out ways of calming some of these tensions, right? And in quotes, resolve Ukraine and Russia, in quotes, resolve Israel. And I don't know. I'm skeptical of all this stuff. I think in general, we're in a dangerous world, a far more dangerous world than people want to admit, because we're distracted by all the social media lights from all these screens we're looking at, while there are actual lights and bombs going off and people dying while we sit in our comfortable lives, and just disregard the horrors that are happening all over the place. I don't think Trump necessarily can change those dynamics. I think those risks keep getting higher and higher over time because this is what people do. Now, where that could manifest into markets is obviously around the price of oil, right? And yes, okay, oil, we have largely control of our destiny here in the U.S. because of how much oil is produced here. But that could still be a source of a sudden surprise, meaning an oil spike. And if that happens, that goes back to my reverse carry trade thesis because it was never about the yen. It was about yen, oil priced in yen, and that's sparking a whole bunch of other interrelated nasty movements. But we'll see. I don't think you can necessarily invest based on geopolitics, but you can size for it.
Now, that's a good point. Maybe it leads to my last question here, Michael, as well. If you had $1 million today to invest, like how would you allocate that money? And again, not financial advice or anything. I'm just trying to it's a nice wrap-up question because it summarizes what we discussed, I think. So I'm curious, how would you allocate $1 million right now, Michael?
I'd buy a series of gyms. I'd invest in a fasting education course, since I've done a lot of that. No, look, if I had $1 million, what would I do? If I had $1 million, I'd probably launch more funds. Now, which is not what other people want to hear, but me saying that basically is implying I would think about putting money to work in things outside of the S&P 500. There will come a point, and I think we're probably close to it. And I've been actually very consistent on this narrative, this idea. I said this 2 years ago or 3 years ago. It's 2 years ago. I said I believe that AI mania, with hindsight, will mark the blow-off top for large cap dominance in terms of the global equity landscape. I've said that many times. And if you look at any chart that looks at top 10 stocks as a percentage of the S&P 500, which is largely tech names, relative to history, you're at basically, all-time highs in terms of how much those large cap tech names contribute to the performance of the index. I maintain that idea. We are in a concentration bubble. That concentration bubble will burst. When it bursts, there's going to be a lot of interesting opportunities because money will then flow into other areas which have been underappreciated, which could include miners, which could and likely would include small caps, banks, value, international, emerging markets. I'm for all of that because I'll tell you what, folks, it's a hell of a lot easier to beat the S&P 500 when it's not the only game in town. And for all the hemming and hawing around how great people's portfolios have done, it's because they're in the right asset class at the right time, which may soon be the wrong time, but they're not going to recognize it until 2 to 3 years after.
The very last point, Michael, is this, I saw the DEUTSCHE as a hedge fund, like the performance chart of the hedge funds. I think Bloomberg published that the other day, and I was shocked. Most of them underperformed the S&P 500.
Of course they have. But of course they have.
I was shocking to see.
No, it's not. I don't think it's shocking. I mean, anything that's active. Okay, look. This is actually, I think, an incredibly important point. Okay. Anything that's tactical or active, you need to still have a tailwind around your opportunity set. Okay. So when you go back to sort of investing 101, idiosyncratic risk is the risk tied to the specifics of an individual company. You get rid of idiosyncratic risk by diversifying. So one company might have positive idiosyncratic risk. Another one might have negative idiosyncratic risk. That's outside of the market. It's company specific. Okay. The equivalent of idiosyncratic risk for anybody that's active or tactical is whipsaw risk. Trust me, I know. Whipsaw risk meaning you get a signal, you get something that says, go into this stock, go into this asset class. It starts to work, but then suddenly you get whipsawed. It doesn't hold. That momentum persistence is not there, and you go back to just large caps because there's no tailwind. There's no cycle that favors the opportunity set. So it's basically a series of false signals, false positives. So in an environment which is purely large cap driven, purely risk on, purely up and to the right, purely select number of stocks, you have to underperform. How could you not? By definition, because you're going to whipsaw because nothing else is working. Right? So, and it's like, all right, so if you're a hedge fund, well, then why not just be in the S&P 500? Because then what's the point of the hedge fund then? What's your value add? Like, even if these hedge funds had performance to match the S&P, what, you think they're going to raise assets? You think they'll get new clients? I deal with 19 mutual fund and ETF issuers who are clients of mine that I do work for in various capacities, either on the content creation side or getting them in front of financial advisors. And all of these guys have a hard time raising assets. You know why? Because you can't really get assets if it ain't broke, don't fix it. If everyone's in the S&P 500 and the Qs, and everyone's just doing rocket ship emojis into their favorite market cap weighted index, which everyone is in all at once. Like, yeah, hedge funds have sucked. Anything that's active and tactical has sucked until it doesn't. And when it doesn't, that's when the S&P is no longer going to be the only game in town. And then you're going to have some real opportunities there. But it's a cycle thing. I always go back to that line. I say it repeatedly. There are no gurus, only cycles. This is a cycle issue. It's not an issue with the hedge fund manager. It's not an issue with the active manager. It's an issue with the opportunity set, which is a function of the cycle that we're in.
That was just interesting. I read a quote the other day. Like the two most successful investors were on the opposite ends of the spectrum. So, like, right? So,
Yeah.
I think that's a perfect, quote for that. What you just mentioned there, Michael. Very, very last point. Like, I want to ask you about your funds you're launching in 2025. What's their focus going to be?
I will keep that under wraps, but there's a lot of interesting opportunities that I will announce when the time comes. I think.
Okay.
Yeah, I've called this sort of chapter 2 of my career. I have 3 tactical strategies which have the same problem in the commonality of long duration treasuries. Ironically, this is probably the year where that starts to make a comeback as I launch these other funds which don't have anything to do with that. People don't understand that when you're a mutual fund manager or an ETF manager, you're not a manager, so to speak. You're really a product developer. You're trying to create a product that people want to go into that's timed right with the cycle, that you don't know if it's timed right with the cycle until you launch and until you have enough hindsight to know if it was the right time. So there's a lot of interesting things that I think are coming from an international perspective. I think from a commodities perspective, and I'm at a point in my career, thankfully, where I've got enough relationships where I can have economic partners and bring interesting new things to market outside of what's happened the last 3 years.
Fantastic. No, Michael, sounds exciting. Definitely we'll keep following you on X here. And maybe quick shout out, where can we follow you? Lead report at .substack.com, I think, is one destination we can send our viewers.
Yeah, and leadlagreport.com. And then, the other business line for financial advisors and fund issuers, I call it Lead Lag Media. It's all still under Lead Lag. It's all been, I think I'm at a hockey stick moment. At least I hope I am. And if it so happens to coincide with the return of the flight to safety, the Phoenix, which is part of my brand and part of my personality at this point, the rebirth, it's going to be a hell of a year.
Yeah, absolutely fits your personal transformation as well. I've been following jealously, or with a bit of jealousy, and
not
jealousy. No, there's like getting inspiration from is the problem. Not jealousy. It's like, oh, this is like something to aspire to. That's the right way to put it. Something to aspire to. So it's inspirational. That's what it is. It's not jealousy. It's inspirational. That's what I meant.
I think everybody should aspire to be the best version of themselves.
No, absolutely. Michael, tremendously appreciate your time. Thank you so much for joining us here on Soar Financially, and need to have you back on. 12 months is way too long. Hope to do this again very soon. So thank you so much. And everybody else, thank you so much for tuning in here to Soar Financially. Hope you enjoyed the conversation with Michael. And if you did, make sure to follow him, of course. You probably are a follower already. He's got 750,000 followers on X, lots of followers on Substack as well. But if you don't, go check it out. It's an interesting follow, interesting read on a daily basis. Lots of daily updates from his side on X. And if you don't follow us, please hit that like and subscribe button. It's a free way to support this channel, and we tremendously appreciate it. Thank you so much for tuning in. We'll be back with lots more here on Soar Financial.